Every now and then, an insolvency story drops like a thunderclap, rearranging the rulebook and keeping directors up at night. Welcome to Insolvency Briefing, your rapid-fire analysis of the one story every boardroom needs to hear. I'm Paul Brindley of Midlands Business Recovery. Let's get into today's explosive tale. On the 30th of June, the High Court wound up Prax's Lindsey oil refinery looted, thrusting the UK's fifth largest refinery into special measures and putting over 400 jobs at risk. Let's talk numbers because they sting. £250 million in VAT assessments from HMRC, £80 million in excise duty and carbon levy calls, and a further £300 million in environmental and decommissioning bond calls. That's over £600 million in sudden claims, and 10% of the UK fuel supply now at risk. When you're in a capital-intensive business, one perfect storm of creditor claims can swamp even the most asset-rich balance sheet. So what should directors actually do? First, run what-if drills on worst-case tax, duty and environmental bond calls. Second, fortify your balance sheet. Think contingency lines or sale and leaseback facilities. Third, pre-assemble your war room. Have government, regulators, lenders and key suppliers on speed dial. Zooming in on Lindsey itself, it's in North Killingholme, North Lincolnshire, commissioned in 1968, still running some core units built in the 70s. A 2018 engineering study flagged the need for up to £300 million in upgrades just to stay compliant and efficient. Here's how the liabilities stack up. £250 million in VAT challenges, £80 million in duty and carbon, and £300 million in environmental bonds. Those bonds work like this. The operator secures a surety bond with a bank, sized for a worst-case cleanup. On insolvency, the regulator calls the bond. The underwriter pays out immediately, then becomes just another unsecured creditor, meaning banks and sureties can face massive write-offs. Lindsey's bonds were probably underwritten by major banks like HSBC, Citibank, JP Morgan and RBC, tied to a $750 million securitization facility. The bank pays first and then often gets pennies back in the liquidation. There's also local fallout. Suppliers like pipeline services and harbour towage are now staring down the barrel of company voluntary arrangements with payouts as low as 45 pence in the pound. If your anchor client fails, your regional supply chain might need emergency CVAs just to survive. So directors, model all liabilities in your real-time cash flow forecasts. Treat surety underwriters as priority creditors once bonds are called. And never underestimate how quickly one insolvency can ripple through your supply chain. That was Insolvency Briefing, one seismic insolvency story unpacked down to its nuts and bolts. For show notes and resources, email Paul at midlandsbusinessrecovery.co.uk. Next time, another must-know collapse. Stay sharp and stay solvent.